Welcome back to Investing Talk podcast.
Today we're looking at Plus Therapeutics.
As usual, before we start, subscribe, like, and comment to this video to support the show. And if there's a specific company you want us to look into, leave it in the comments below.
So let's get into the analysis.
Let's do it.
Okay, so what we're looking at here is a highly specialized clinical stage oncology platform. It's focused entirely on the central nervous system.
And what's interesting, for a company that's mostly in development is that they already have some real commercial traction.
They do. It's a key part of the story.
Okay, so let's unpack this financial snapshot because the numbers, they're always the bedrock, right? Especially in biotech.
Absolutely.
The revenue trajectory is definitely pointing up, which is encouraging. They pulled in $5.82 million in 2024.
Which is a solid, 18.5% jump year over year, up from about $4.9 million the year before.
That seems like a crucial sign. It shows their product is actually getting out there.
It does. It shows CNside is gaining a foothold. But we have to talk about the other side of the ledger.
The losses.
The losses. They're still a development company, so they are burning cash to fund these trials.
Right. They recorded a net loss of, $12.98 million in 2024?
Just under $13 million, yeah.
But here's the part that, gives me pause. That's only an improvement of about 2.5% from 2023.
It looks marginal.
It seems tiny. Should investors really be celebrating a 2.5% improvement when they're still burning $13 million a year?
Well, in this context, that small percentage is actually a really good sign. It's a sign of early operating leverage.
Okay, explain that.
It means that while their revenue grew by almost 19%, their overall costs barely budged. So they're managing the expense side really well while ramping up sales. That's exactly what you want to see.
So they're being efficient with the capital they do have.
Incredibly efficient.
Yeah.
And they're directing that capital right where it needs to go, REYOBQ and the CNside rollout.
So even with the street expecting negative EPS next year, around negative 18 cents, the key takeaway is the trend. That loss should start to narrow as revenue really starts to accelerate.
That's the bull case right there. And the annual loss, under $13 million, it's manageable. It's not like some of these other biotechs burning hundreds of millions.
Right. Which brings us to the core of the story, the assets themselves. This isn't a broad cancer play. They've staked their claim deep inside the CNS space.
Specifically, leptomeningeal metastases.
What makes that area so valuable?
Their competitive moat. Leptomeningeal metastases, or LM, means cancer cells have spread into the cerebrospinal fluid.
The fluid bathing your brain and spinal cord.
Exactly. And it is exceptionally difficult to treat. Most drugs just can't get there effectively, and traditional radiation is, it's messy. A lot of collateral damage.
So you have this huge, immediate unmet need.
Which means very little competition for anyone who can actually crack the code. They have the IP in targeted radiotherapeutics and diagnostics for this exact niche. If they succeed, they could own this market.
Okay, let's start with the therapeutic side. REYOBQ. It's a rhenium-186 radiotherapeutic. How does that work differently than, standard treatments?
So instead of systemic chemo, the rhenium-186 is delivered directly into the cerebrospinal fluid.
Right to the site of the disease.
Precisely. This allows for, extremely high doses of radiation right on the cancer cells, but it minimizes the damage to healthy brain tissue. It's designed to just bypass all the problems that standard chemo runs into.
And they just presented new data on this, right, at a big conference.
They did, at the 2025 WFN OSNO meeting.
And for our listeners, why is that specific meeting such a big deal?
Think of it as the Super Bowl for neuro-oncology. It's the premier global meeting for doctors and researchers in this field. Presenting positive data there is like ringing a bell on Wall Street. You're validating your approach in front of every key opinion leader who matters.
Okay, so that's the therapeutic. Now let's talk about the other asset, the one that's actually driving revenue right now, CNside.
Yes, the diagnostic. It's absolutely critical to their whole strategy. It's a specialized liquid biopsy platform, but it uses cerebrospinal fluid, the CSF.
Not blood like most liquid biopsies.
No, and that's the key distinction. Blood plasma is great for systemic cancers, but it's not very reliable for finding cancer cells hiding out in the CNS. By looking at the CSF directly, you get a much, much clearer picture.
And why is that so important for an oncologist?
Because it doesn't just say, yes, cancer is here. It can actually quantify the disease burden. It can tell the doctor if a treatment is working. and it can monitor for mutations in the fluid.
That's a ton of data.
It's exactly the kind of rich data they need to make decisions. And once a doctor gets used to that level of information, it creates really high switching costs. They're not going to want to go back to the old way.
And their commercial strategy is also super focused. They're starting in Texas, targeting these big NCI-designated cancer centers.
It's the smart play. For a microcap, you can't afford a huge national blitz. You go for entrenchment. You win over the thought leaders at the major hospitals, make your product the standard of care there, and then expand.
So you build a solid foundation first.
A very strong foundation that generates high-quality, reliable revenue.
All right, let's pivot to the market reaction. Because with assets this potentially valuable, I'm curious how the stock is behaving. It's been in a tight range, 60 to 70 cents.
But the 52-week range is huge, from 16 cents all the way up to $2.31.
That just screams optionality.
It really does. And the technical picture, it's starting to look stronger under the surface. The stock is trading just above its 200-day moving average,
Which is sitting around 59 cents.
Yep. So for anyone who follows charts, holding above that 200-day is the line in the sand between a long-term uptrend and downtrend.
So it's building a base.
It's building a base above critical support. And you combine that with some momentum indicators like the RSI around 62 and the CCI above 100. It suggests bullish momentum is starting to creep in.
And that sentiment seems to be driving institutional conviction.
Absolutely. We've got 25 funds with positions, but here's the really telling stat.
The flow dat.
The average portfolio weight of those funds is up 83% quarter over quarter.
So why is that metric, the average weight, so much more important than just the number of funds?
Because a lot of funds might just be index trackers taking a tiny passive position. But when the average weight shoots up like that, it signals high conviction buying. These managers are actively increasing their bet because they see something.
You're not just dipping a toe in.
No, they're diving in. And you see that mirrored in the analyst ratings, which are basically a strong buy across the board. The news flow has been great team expansion, the positive data, good FDA meetings.
So what are the analysts saying for a price target?
Well, this is where the optionality becomes crystal clear. We're seeing 7 analysts with an average 12-month target somewhere between $7.25 and $8.
Wait, from 60 cents? That's 1,000 to 1,200% upside.
It's massive. But you have to remember, that target isn't based on today's revenue. It's valuing the company almost entirely on the future harm run potential of REOBQ.
And that kind of return only comes with a lot of risk.
A tremendous amount of risk.
Okay, we have to look at the bear case now. Let's start with the most immediate structural threat, Nasdaq compliance.
That is the elephant in the room for any stock under $1. They just got a 180-day extension to regain compliance.
So the clock is ticking.
It's a very serious concern. They need the share price to recover on its own.
Because if it doesn't, the big fear is what? A reverse split?
A reverse stock split.
Yeah.
And while that fixes the technical problem, the market almost always sees it as a negative signal. It can just crush investor confidence.
So that external pressure from Nasdaq links directly to their core business risk?
Absolutely.
Yeah.
They're still burning cash. Any misstep, any delay in the REYOBQ trials, or a slower than expected C-inside rollout.
And they have to go back to the market for more money.
Which means dilution for current shareholders. It just extends that path to profitability and puts more pressure on the stock.
So the high risk is basically the price of admission for that potential 10x reward.
That is the trade-off, perfectly put. The market sees a binary outcome. Either they succeed and potentially own this CNS space, or they fail and shareholders face significant dilution.
So what are the milestones? What should investors be watching over the next, say, 12 to 24 months?
Okay, there are a few clear catalysts. First, the next earnings report, probably mid-November 2025. We need to see that revenue growth continuing and the losses narrowing.
Proof that the commercial strategy is working.
Exactly. Then beyond financials, there are 3 big things. First, keep watching the C-inside rollout. We need to see more account wins at those big cancer centers. We need follow-up guidance from their FDA meeting about REOBQ. Getting clarity on the regulatory path forward is probably the single biggest catalyst they could have.
And third?
More data. Any follow-up presentations after that big WFNO no event that can keep reinforcing the drug's efficacy and safety signals.
And all of this is happening at a time when the sector itself has some tailwinds.
It does. We're seeing a risk-on rotation back into small-cap biotech, which helps. But more importantly, there's a huge industry focus on radiopharmaceuticals, and precision oncology right now.
Lots of M&A activity in that space.
A ton of it. And that puts a company like this on the radar. It adds a sort of strategic option value.
So a big player might be looking to acquire them to get into this niche CNS space.
It's purely speculative, of course, but if RayWayOBQ continues to show promise, you can bet larger oncology players will be watching very closely. It's part of that high beta profile.
Okay, so to pull it all together.
It's an asymmetric opportunity. You have these differentiated CNS-focused assets in a space with a massive unmet need. It's a high-conviction, leveraged bet on clinical and commercial execution.
That raises an important question for you, the listener. Given the significant technical, commercial, and clinical hurdles this company still faces, which of the two primary assets, the commercially active, revenue-generating diagnostic CN side, or the potentially transformative, regulatory-focused therapeutic RYOBQ, will ultimately provide the quicker path to sustainable institutional confidence and deliver that massive upside?
And if you enjoyed this analysis, please hit that subscribe button to keep getting insights like this delivered straight to you.